The Paper Stack Podcast. We're back. It's been a while. Sorry, we've been
vacations,
back to school, fundraising. It's just been an insane past 3 or 4 weeks. So we're back. We apologize for the delay, but
we had to dust off the cameras and everything, and here we are. But it's good. School's back in session. Kids are back at school. I'm happy.
Are you happy?
Oh, yeah. They got structure. They are not just sitting there and they're trying to figure out how to entertain them all the time.
It's just so quiet in the house.
Yeah,
it's so
nice.
quiet. It's just beautiful.
Yeah. So
what do you got for us today? What are we talking about? Lots going on in the note industry. Lots of questions coming in.
Right. And that's what we're going to do today. Is we're going to look at. We have people that come on the site quite often that ask about the acronyms. They're always like, what the heck's UPB? What's ITV? What's ITB? What's this mean? And I'm like, well, and then so I was like, that's actually a really good topic of discussion because a lot of people don't know what ITV is. And
actually, ITB, people said that we made up.
Really?
People say that was you guys, ITB. People are like, I never even heard of ITB.
That's not really true though, right?
How would I know? I didn't think so. I thought it was common knowledge, but we'll go over that stuff right now.
Okay, well, we'll start with this. The one that most people are curious about is UPB. And so
UPB, this one is very basic, unpaid principal balance. So this is whatever the principal is that they owe you. Not the total payoff. The total payoff, if it's a non-performer, would be the unpaid principal balance plus any arrearage, past due interest or lender advances, stuff along those lines. So UPB, unpaid principal balance.
Now let me ask you a question. When you have a performing note, does UPB always match the total payoff?
No, it won't. Some reasons why it might not happen is if there's an escrow account, right? Or there's an arrearage account and it's a performing bankruptcy 13 loan. There's a number of things, or maybe you've got a forbearance on there. There's a couple reasons why it might not add up.
We usually, the servicers are collecting escrow.
Correct, but so if you go look at, for instance, the total payoff might be, or the unpaid principal balance might be $55,000 even, right? That's the unpaid principal balance.
Okay.
But the total payoff might be $54,000. So it's $1,000 less, right? Because there might be $1,000 that they've prepaid in escrow for taxes and insurance that they're being held in escrow right now. So if they were to request a payoff today, that number would be less because there's $1,000 that they've already paid in that they're not going to use that's ready to go.
Right.
Or that they have to, they figure out the prorations and stuff like that. So yeah, you could run into a performing loan that has a lower payoff than the UPB.
Is that typical?
It's out there.
It's out there?
Yeah.
But most of the time, UPB.
Yeah, but whenever you go get a calculation from your servicer, they'll give you a breakdown.
Okay. Interesting. But with UPB on non-performing, that's more important because a lot of times they have, what are the differences? I know first off, they're not paying, so they're going to have whatever lawyer fees just for late fees.
Right. So the unpaid principal balance is just the principal on the loan that's owed, right?
Right.
And then the total payoff will include any past due fees or past due interest that's been accruing because they haven't been making their payments.
When you're bidding on a note that's not performing and you're looking at that, at that point, would you be bidding off the total payoff or bidding off the UPB?
That's a great question. That's a great question to ask because that is really up to the investor. 5 years ago, 6 years ago, I would be like, strictly off the balance.
Really?
But now as real estate values have risen, I've seen some people selling loans request your bids to be based on the total payoff. So, but that's up to the investor who's buying it. And you have to figure out what your risk tolerance is. See, the way it goes is sometimes they give you a total payoff and they say you need to bid on the total payoff. Well, occasionally what will happen is you go to foreclose to try to foreclose on an asset to try to recover your money, get the house back, whatever. Mm-hmm. And the borrower has an attorney and they're going to start challenging all the stuff on the total payoff.
Oh, wow.
Right? And if you don't have documentation to back it up, all of a sudden, even though it might be a legit payoff, but if you don't have the documentation to back it up, you have to shave it.
Really?
Yeah, because it's you can't provide proof of it. So maybe the person you're buying it from is including past due taxes from 3 years ago on escrow advances.
Right.
In there. Well, unless you can get the person, and maybe there's somebody who owned the loan 3 investors ago, and you're like, look, I need to show that was paid by you. I need that receipt of payment.
Wow.
If you can't do it, and it's a $20,000 fee or $20,000 taxes, you gotta shave that off.
Wow. Learn something new every day. That's interesting.
And look, I've done it both ways. I predominantly buy based on balance, principal balance. I have purchased based off of total payoff, or ran numbers against it so I could see what my worst case scenario was.
Interesting. Okay. All right. Okay. Moving on. So let's see here. The next one that I get a lot of questions about is ITB, and I still don't feel confident in answering it. So
investment to balance. What are you buying it for to the balance of the loan? And it's just a percentage. So if the balance is $100,000 and you're paying $70 for it, your investment to balance is 70%.
Mm-hmm. So that the balance is at the same. That's the unpaid principal balance.
Correct.
So ITB is investment to unpaid principal balance.
Correct.
Okay, that makes sense. And why is that important?
People might use that more so for cash on cash returns or calculating. You'll definitely use it if you're calculating your yield.
Explain to them cash on cash, because I hear that C but I still kind of fuzzy. Like explain, because
right. So a cash on cash return, just you buy something for $100,000, you're getting $1,000 a month on it.
Mm-hmm.
You've got
10%.
10%.
Okay.
Well, no, 12%.
Oh, because every month. Okay.
So you have 12,000, so that's 12%. It's just the cash return on the cash put out. It's tough to look at it like that when it comes to investing in mortgages,
mm-hmm.
because unless it's an interest only loan. If it's an interest only loan, you're getting straight interest. It's a cash on cash. But if it's a fully amortized loan, that doesn't really hold true, because you're getting back a chunk of principal and then you're getting back a chunk of interest. And really, you should be recovering your principal as you go, and your interest is kind of the return.
Return, yeah. Okay. Interesting. Okay. All right, good. All right, going down the list. ITV.
Investment to value?
Yeah,
investment to value. That's going to be your investment to the value of the actual house.
The value of the actual house.
The underlying collateral. What's securing it?
So if I bought this note for the investment amount of $100,000, the house is worth $200.
If you bought it for $100 and the house is worth $200, it would be a 50%.
And what is a good place to be with ITV?
It all depends on if it's performing. Is it non-performing? I tell you, a bad place to be is anything.
It's negative.
Yeah, exactly. Anything. If you're at 103% of value, that's not good.
Yeah.
So if you
bought,
so you're not going to run into that typically right now. I mean, I guess I take that back. You might run into that if you're buying. No, you wouldn't even run into that if you're buying some like fix and flip loans. You might. Some people ask a premium on those. Like they'll ask for 102% of value or 102% of the balance, but you're never going to be. You shouldn't be upside down on investment to value. That's just a bad buy.
When do you use investment to value? I mean, like when you're evaluating a note, I'm looking for one. Let's just take this one for example. We're looking at this one that's performing first, and it's whatever, 58,000 on the UPB. I mean, we don't have investment to value.
Property value is 131,000. What's the purchase price? 40. So both of those, you're kind of is it performing? Yeah, you're kind of in the money there, right? Because you're buying it at a discount of the balance. You're buying it at a discount of, obviously a discount of the value.
Mm-hmm.
So you're good. Like some people look at, well, when would I want to buy based off of the balance versus when would I want to buy based off of the collateral value?
Yeah.
So if the balance is higher than the collateral value, so they're upside down in their loan. So they owe $176,000 on a $100,000 house.
Right.
I'm not buying off of the balance at that point. I'm looking at what's the underlying collateral.
Right.
And I'm buying based off of that, because ultimately what's going to happen is I'm not collecting. I don't really have a way that I can easily collect the 100 to the 76,000, that $76,000 gap there, unless you get, deficiency judgments and all that stuff. And then of course, you can try to squeeze blood out of a rock. But so if the house, if they're underwater, you're going to go ahead and go off the value. Now, if it's the opposite way, like this loan here, I'm bidding that one based off of the balance, because the balance is much lower. Even if it's a little bit lower, you want to bid based off of that. But in this case, this one was, it was much lower. It was $58,000, and the house is worth $132,000. It wouldn't make sense for me to offer 50% on the value of the house, because that'd be, what's that, $76,000
right.
or no, $66,000.
Yeah, 13. Yeah. Mm-hmm.
So you see what I'm saying? Because you would be bidding more than the balance on the loan. So in this case, if the balance is lower than the value of the home, you go ahead and bid based off the balance.
So is this a good rule of thumb that if based off what is the balance and what is the value, whichever is lower is what you're basing your bid off?
Pretty much.
Yeah. Right.
Pretty much.
So if the balance is lower than the value, you're doing ITV. If the value is lower than the balance, you're doing ITV.
Correct.
Yeah, okay. That's good to know. And then within our filters here, I mean, putting a min and a max, is that important? I mean, what would be a min and a max that matters?
Investment to balance.
Like an investment to balance, min and max. I mean,
yeah, I'm sure somebody's got a use for it. I typically don't. I just look at the whole deal and figure it out. I don't want to rule anything out.
you don't want to rule anything out?
I don't want to rule anything out. I want to see everything there, because I'll look at stuff and I'll be able to look at it quickly and figure out, hey, is there something I can do with this or not?
So an investment to balance and investment to value is not a first thing of a metric. You're looking at first is what is performing, what's its state, is it judicial or non-judicial?
Yeah, I get there and then I go and I look at it and I say, okay, where are we?
Based off this is how I'm going to bid.
Yeah, you might look at the investment to balance and say, okay, look, I don't want to be over 90%, and maybe you have fund metrics that are like, look, I can't pay more than 85.7% of the balance on the loan. We have to build in this margin. That's a super valuable tool, because you can kick out anything that's over that.
Okay.
Me, I tend not to do that just because of human error. I want to see everything we have available.
Got it. Okay, I'm learning here. And now the last one that's an acronym that people use a lot, and this one's pretty popular, is the loan to value. Loan to value.
So that's what's the balance on the loan compared to the value of the house, right? If the balance of the loan is how much equity is in there. If they have an $80,000 loan on a $100,000 house, they got 20% equity. And the reason why that's important to look at is just the borrower's motivation to what are they going to lose if they stop paying,
right? And
what's the insurance that they're going to continue to pay?
Is LTV more important on performing or not performing?
It's more it's important on both.
It's important.
It's important on both to look at, because you want to know, where is this borrower. It's important on both. You want to know both of them, because if it's performing, you want to know what's their motivation to keep it performing, or if it's not performing, hey, what's their motivation to work with you to get it re-performing, or what are the chances of them doing a short sale, or just not even a short sale, I guess, if they're in the money, what's the chances of them just listing it for sale and selling? So I would say it's important on both of those, just to see what the LTV is.
So LTV is the emotional equity trigger.
Well, the LTV is the financial equity,
but also it's emotional equity too, right? Because they have equity, right?
No, emotional equity is like
more like the pride in the house.
Pride in the house. I grew up in the house. My mom. I was born in the house. I grew up. That's the emotional equity. I don't want to see it leave. I lost my husband. It's the last thing I had. We had together. That's the emotional side. The dollars and cents and percentages. That's the financial equity.
It's financial equity. Okay, I think that's the metrics that people always ask about. I mean, besides that, I can't really think of any other acronyms. I'm sure there's something else that
No.
You good?
I mean, I'm sure if you could, DTI, when we could.
What's DTI?
Debt to income.
Oh, debt to income ratio. Okay.
Yeah, debt to income ratio. And that's if you're looking at the origination file. Like, hey, if they've got a DTI and it was like 55% at the time of the loan, it's like that's something you want to look out for, right? Because they probably couldn't afford the loan then. Mm-hmm. Or if you're considering buying a non-performer and turning it re-performing. Maybe they were at a 35% DTI when the loan was originated, but it's a non-performer now. They've lost some income. So you want to know what's the DTI, what's their debt-to-income ratio? Do they have room in here? Do they have room to actually modify this, or is this one going to go the distance of foreclosure? Or are we going to do a loss mitigation package? And
that makes sense.
So that's
where do you find that metric on our site, or is that just something you have to ask for?
That's something you kind of derive by looking at the borrower's financial statements. The borrower, what's their income versus what's their expenses. That's going to give you their debt to income.
And that's something maybe you can ask for from a seller, or is that something?
No. If you get the origination package, yes. There's some of the more institutional seller or buyers are going to ask for that because if you're buying, if you have an institutional buyer purchasing loans from you, there's a good chance that what they're doing is they're going around aggregating a bunch of loans from different people that they're going to buy and then eventually collateralize.
Okay.
Securitize.
Interesting. Okay, well, this is straight to the point. Really, we just wanted to get this out here because this is asked quite a bit, and I would like to have a place to direct them, and I can actually watch this video and learn a little bit myself.
Always good to teach.
Yeah.
Happy to teach.
Yeah.
Good to be back.
I know. It's
lights,
nice.
Camera, action.
Yeah, I know. So we're going to be doing more of these. We're going to do it once a week. If you have an acronym that's in the space that we're in that Rick can help explain.
Leave a comment that you have a question about, and we'll get to you and we'll respond in the comments.
Yeah, and I guess that's it for this one, but we'll see you on the next one. So.